and the data that the Fed is formulating policy decisions around have a much wider error term around them than they ever have in the past. That's where, once again, you get to a classic policy misstep, where this will basically be a major Homer Simpson dough. That's what it's going to be. They were scrambling to raise rates. They'll be scrambling to cut rates. It'll be in a totally different market and macro circumstance than we have right now.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Today's guest expert just released a warning that the official jobs data reported by the government are, quote, overstated by historical proportions. And when the downward revisions get released, it will shock both the Federal Reserve and the financial markets. For the details on this, we turn to the man who wrote the report, highly respected economist and award-winning researcher David Rosenberg, founder and president of Rosenberg Research. David, thanks so much for joining us today.
Well, Adam, it's great to be on. Thank you.
Hey, it's always a great pleasure. Lots to talk about. Really want to dive into that new report with you. But if we can, let's kick this conversation off at the high level that I like to whenever you're on. What's your current assessment of the global economy and financial markets?
Well, I guess I would refer to it as the Flat Earth Society.
Hmm.
So the global economy, I would say, is pretty flat. There's moving parts. Of course, if you look at the U.S., the cleanest shirt in the laundry basket. However, even the mighty U.S. economy, which was growing over 3% last year, saw its GDP growth throttle back to 1.6% in the first quarter. So things in the U.S. are cooling off. Europe is actually surprisingly doing a little bit better. For the most part, another recession was averted, and that's the good news. However, the economy there is pretty stagnant. Japan, I would say, again, pretty stagnant. China seems right now to be printing a little bit better data. However, their economy is still really struggling under the weight of the lingering property and debt crisis that's going on there. So, you can pick and choose, other parts of the planet. In Europe, for example, Spain, Portugal, and Italy, the basket cases that we talked about every day a decade ago, they seem to be outperforming, the core, France and Germany. You've got India, which is seeing tremendous productivity-led growth. So you have some areas of the world that are showing some panache. Canada, of course, I sit here in Toronto. Canada has this allure of positive growth, although it's anemic, it's less than 1%. But in the context of 3% population growth, real per capita GDP in Canada is actually contracting at an epic 2% annual rate. So uneven. Some areas doing better than others. India is still red hot. But outside of that, very uninspiring global economic backdrop right now.
Okay, and just real quick, when you look over at the markets, how would you generally categorize them?
Well, you've got some markets that truly have secular tailwinds. I mentioned India before. And the market is trading at lofty valuations, so a lot of the good news is priced in. However, Modi, might be a divisive nationalist leader, but what he's done, he's pulled a Reaganomics when it comes to a lot of the structural changes taking place in India. So you have 8% growth. It's being fueled by productivity, which is why they're having tremendous growth and declining inflation. It does sound like what the U.S. experienced in the 1980s for anybody that remembers that period. Japan is consolidating right now, but after a phenomenal year, it's still one of the best stock markets year to date. And we're seeing the last leg of Abenomics, the structural reforms taking place, the pressures from the regulators on the corporate sector to remove idle cash. and return it to shareholders. When you look at Japan, you're seeing the all-in yield, dividends, buybacks, amongst the most alluring on the planet. Those are some critical areas that are doing very well. Europe, very interestingly enough, Europe having averted a recession and averting an energy crisis. That's been a tremendous. Actually, people don't talk about Europe actually outperforming the S&P 500 this year. And of course, part of that is the fact that you had a lot of bad news priced in, and the bad news did not happen. But their market is like trading at historically low multiples, so they're a better valuation play than in the United States. Of course, when I get asked the question, Adam, about my view in the stock market, and I didn't start off with it, invariably that's all people talk about is the S&P 500. But from my vantage point, it's become a very speculative market, and it's trading at a 21 forward multiple. And so, unlike Japan, where the multiples are high, but you're competing against bond yields that are 1%, I see in the United States the front end of the curve, almost 5% yield, the 10-year note, well over 4%. The bond market is trading actually very attractively relative to equities for the U.S. stock market. So I still think that although the best companies in the world are populated in the S&P 500, of that there's no doubt, they're just right now not the best stocks. If you're a global investor and you're looking for relative value and true secular tailwinds, there's other places in the world to park your money in the equity market than the U.S. right now.
Okay, better relative value to be found elsewhere outside the U.S.
Let me just add that we're trading in the top decile, top 10% of valuations of all time. And I like to invest and make recommendations off of markets, asset classes that have a tailwind. I'd rather be investing at a time when the valuations are in the bottom 10% than the top 10%. And valuations are never a timing tool, but they do provide investors with a window of what their expected future returns should be. When you're trading at a 21 multiple, you're priced for a lot of good news. And as we've seen during this earnings season, and a lot of the earnings, not everybody, obviously, especially in the retail sector, but a lot of the earnings have come through. But yet you're finding that the companies right now that are coming through are beating their earnings. Their stock is not going up that much. And this is something that's brand spanking new this cycle, that companies beating their top and bottom lines are not being rewarded with the same degree of exuberance by the investment community as they had been in quarters past. And that's just a case of the proof of the pudding's in the eating, in the sense that that is a signal that it's a fully priced market.
Got it. It's you get to a point where you have sort of maximum exuberance where the ball just can't go much higher. It sounds like you're saying that's sort of where we are with valuations. Feels like that, at least.
Yeah, look, I would not. I mean, look, we have a very highly concentrated market, that's still dominated by a handful of stocks. But you can always buy sector ETFs. When people say to me, so I talk about the S&P 500. I talk about it in a global context because I've been recommending for some time that investors take their terrific profits in the US and deploy it to other areas of the market that have lagged behind, and trading at better valuations that actually, tell you the truth, also have greater secular tailwinds. And Japan has done better than the S&P 500. People tend to forget that. We're so myopic in our view. And when I get asked this question about the stock market, it's just a synonym for the S&P 500, but there's another 60-70% of the stock market out there globally that you can look at. Europe, and when I pull my clients, nobody knows that old Europe has outperformed the S&P 500 this year. And I have to show people my Bloomberg screen to prove it to them. They have no idea. And look what's happened very recently, and we've written about it. Is the Hang Seng, Hong Kong, which is the poster child for emerging Asia. And what's happening is there's some regulatory changes taking place there as well that is providing more liquidity for their marketplace. And Hong Kong, which was dead in the water just up until about 2 months ago, is back into an official bull market, and now rivaling year to date what the S&P has provided. So they're trading, the Hong Kong market's trading with an 8 multiple, Adam, an 8 multiple, which by the way was where the S&P 500 was trading, an 8 multiple, in August 1982. And I'm pretty sure, and you would not have convinced anybody back then, that August 1982 would have been the launching pad for a 2-decade secular bull market. So there's other things in the world that are happening where I think that there's no such thing as a sure thing in this business. No guarantees. But there are other areas of the world that have, I think, better valuations and better tailwinds. So I am not against the stock market one bit, but I don't choose to invest in overvalued, inflated assets within any country.
Okay, which obviously makes sense. Who wants to buy overinflated assets? So, all right, David. So, I've talked to you a fair bit over the past couple of years, and I hear you saying relatively, relative to let's say the past year, a lot of these other countries, or past 2 years, a lot of these other parts of the world are actually doing pretty darn well on a relative basis. Growth is still anemic in some of these places. It's not like they're problem free, but you're saying they're doing better than they were. And from a stock market perspective, a lot of them you think offer better value with tailwinds versus the US. This sounds more bullish. I don't want to necessarily say raging bullish, but it sounds more bullish coming from you about the global economy than I believe you were when we talked, say, a year ago. Is that true? And if in your answer, can we just address the question of, a lot of people thought that definitely a recession was going to come in 2023. It didn't, and we still don't see one on the roadmap in 2024. Did we dodge that bullet, or is there a shoe still waiting to drop here?
Well, I'd say, firstly, and putting the global hat on, Europe benchmarked against expectations has been one of the big surprises. And now, in absolute terms, like you said, are they doing great? No. But the recession call in Europe looked a lot more ironclad than it did in the US. Now, look, their economy, they just printed their latest GDP numbers for the first quarter, and good Lord, if you print a number like a 1% annual rate growth in Europe, it's like break out the champagne. I mean, that's I don't know how you say it in French or German or Spanish, but I mean, 1% growth. The new normal is like that used to be what 4% was decades ago. So yeah, I think Europe, and that's showing up in their stock market, because the stock market will always react to what is being priced in. Europe has definitely been an upside surprise, and now the ECB is going to be cutting rates next month. I think what's happened in Europe is their inflation rate has come down dramatically, and the ECB is sounding a lot more dovish than the Fed. They have a super duper competitive exchange rate with the euro, like 107. I mean, you and I both remember when the IPO for the euro back in 1999 was 117 and change, or 107. So they, much like Japan, Europe has lower rates than the US. They have a central bank that is less bellicose than the Fed. And I'd have to say relative expectations have been an upside surprise there. So to get that out of the way. Now, as far as the US is concerned, I think you're quite right. The recession call got jammed up, and got jammed up by what? Well, for example, the budget deficit last year exploded by 25%. You had really unanticipated fiscal stimulus. And a lot of that were those Biden subsidies to the industrial sector. In fact, what was fascinating in 2023 was that the construction of manufacturing facilities ballooned 60%. not 16, 60%.
Mhm.
In the same year where industrial production was negative. So we're building all these facades, we're building these factories because of Bidenomics, and there's been no production. It's like we've created this Potemkin village, and we'll see the extent to which the production follows suit. But right now, these are empty manufacturing facilities, but it created a boom in industrial construction. Industrial construction was a hallmark of growth last year, and that was basically the Biden subsidies. In fact, the fiscal stimulus last year wasn't even so much on the spending side. We have enough of that. But how often in the past have we had, say, 6% nominal GDP growth, which is what we had last year? Uh, and yet government revenues were down 7%. Normally, a 6%
Mhm.
nominal GDP stream will generate an 8% revenue stream for the federal government. Because of those massive subsidies, government revenues for the first time ever were down. Were down. You would have thought, looking at the revenue numbers, that we had a horrible recession last year, but that was the fiscal stimulus. Those were the subsidies at play to generate that economic activity on the industrial construction side. Non-residential construction boomed last year. So that was a big part of the getting jammed up on the recession call. What else? Well, we had the last leg of the excess savings file kicking the US consumer into an elevated gear. And this came as a big surprise, especially to me, because history shows, and maybe we shouldn't be relying on history anymore, because as narcissistic as the US consumer's always been, you're talking about a 3 standard deviation event that, when Joe Biden was told by his economists in the opening months of 2021, go big or go home. All the academic research showed that when the US household sector is confronted with a stimulus check, they save half and they spend half. This is $2 trillion in one fell swoop. We all won
Mhm.
the lottery. No matter your income, no matter if you had a pulse or not, no matter who you are, you got a stimulus check, but it was so damn big, you couldn't possibly spend it all at once. Well, historically, the household sector spends half and saves half, but not this crew, not today's household. All of it got spent. The rest of it got spent last year. And that was a big part of the ongoing strength in the consumer. It wasn't about jobs, wasn't about organic income. It was about the continued drawdown of those excess savings. And then on top of that, what happened that I certainly didn't anticipate was that we were going to get double-digit growth in credit card balances.
Mhm.
10% growth in credit cards. We've reached a situation now where the average American household has 4 credit cards. Never happened before. Dad has a credit card, mom has a credit card, Janie has a credit card, and Fido the dog has a credit card. And so that was happening as people who were starting to see that they had spent the last of the stimulus checks then resorted to credit cards, notwithstanding a 25% interest rate on those unpaid balances. And so it is interesting because we could see the quality of these debts because the delinquency rate, and we're not talking about the 30-day, the serious 90-day delinquency rate on credit cards has gone up to where it was in 2011 when the unemployment rate was 9%, not sub 4, which tells you something. And now we're talking about a $1.3 trillion liability. This is as big as subprime was, back in 2007. And I think we should ask ourselves the question, how is it that we could have a delinquency rate this high with the unemployment rate this low? But when you look at the data and you look at the government sector last year and the expansion of the deficit, and then you apply the traditional multiplier impact of that on the economy, and then you weigh in the last vestige of the excess savings file and the boom in credit card borrowing. And that was 100% of the growth in the economy last year. 100%. So the recession call, what stood in the way of the recession call? Fiscal stimulus, the last vestige of the savings drawdown, and this incredible boom in credit card borrowing and spending. And that's your story. That's how we averted a recession.
Okay, thank you. Super helpful. So we're on the consumer side of things. We're still at like really historically low savings rates, right? Right now.
Savings rate is around 3%. And in the pre-COVID norm was closer to 8%. And
Okay.
so you're 100% right. And that is and a lot of that is because of the credit card borrowing, because the borrowing is a source of cash flow, but it's not part of income. But yeah, the savings rate is at historically low levels. And again, I didn't think that at this stage we'd be down to 3%. You know, historically, Americans put away 8 cents in the piggy bank for every after-tax dollar they earn. Now we're down to 3 cents. So you're asking, yeah, exactly. How is it that we managed to avert a recession? Well, that's another big part of the puzzle is this ongoing willingness to draw down the savings rate to historically low levels to sustain our consumption patterns.
Got it. Got it. So we're basically, we've been eating our financial seed corn to keep the economy fed, if you will, at least on the consumer side here, where we got a ton of money from the stimulus. We didn't save any of it, basically. Previous times when consumers got stimulus, they saved about half. You're saying this time we spent it all. Not only did we spend it all, but we have then drained our average savings down, which has been an additional stimulus of the economy. And we have not downshifted our spending. We have simply shifted it from savings or income to the credit card.
Well, and there's something else, Adam, that I didn't mention that deserves some attention. That comes down to the drawdown of the savings rate to these levels that we actually had back during the housing boom in 07 and the dot-com boom in 99, 2000. You tend to get a savings rate drawdown of this magnitude. I never said it was unprecedented. It was just extremely rare, but it happens after an asset price boom. And that's what we've had between the equity market and the housing market. And don't forget that house prices are going up for the wrong reasons. They're not going up because demand is strong. They're going up because there's no supply in the resale market. So even if you have weak demand with no supply, prices can still go up. This isn't the same thing that happened in the mid-2000s when it was really demand-led. This is a very unusual situation. Home prices going up at a 7% annual rate after a 525 basis point rate cycle is, well, that's enough to cause your head to spin. But look at the stock market. So in the past year, the amount of net worth, the value of wealth on household balance sheets has mushroomed by almost $12 trillion. That's like half of GDP got lopped onto household balance sheets just in the past 4 quarters. So everybody is feeling wealthier. Well, I guess not everybody. Whoever owns assets, you feel wealthy. And so you're looking at your 401ks and you're looking at your stockpile of assets and you're looking at your house and your vacation home and your equity portfolio. So you say, well, why shouldn't I spend more of my income because my stash of assets are going to look after me in my old age. So why bother saving? And so there's that part of it too. It always seems to happen as classic peak of cycle, right? Like when you start getting the unemployment rate with a 3 handle, and we've been there for some time, and you get the savings rate with a 3 handle, that is very, very late cycle. Very late cycle. When the savings rate is like 10% and the unemployment rate is like 5, 6, 7%, that's when you built up a lot of spare capacity and you got a long runway for growth. Well, we don't have that right now. When you get a three handle on both those indicators, you are bumping against a wall. And that's why, by the way, I'm not throwing, I guess you can call me stubborn. I'm not throwing the recession call away. I've admitted that I was wrong last year. I'm wrong for these reasons. A lot of those reasons are non-recurring. So I'm saying delayed is not derailed, which, by the way, are the words I was using back in 07 into 08 when the same questions happened in 07. Where's this recession already? Next thing you know, it's starting at the end of 07, but it took a long time, and there were things getting clogged in the way then too. There was the elongated cash out refinancing craze and mortgage equity withdrawal. There was still that last vestige of all the wealth created by the housing market. You had Alan Greenspan and Ben Bernanke saying house prices never decline on an annual basis. Don't worry, be happy. The problem is subprime will remain contained. Don't worry, be happy. And so, there was that other aspect of, yeah, I'm looking at my McMansion, and why would I bother saving any money? And people drew down their savings rates right up until the point where they couldn't do it any longer. And that started at the beginning of 08.
Mm-hmm.
So all the people in 07 saying, where's this recession already? Well, they stopped asking that at some point in 08. You brought that up before in your opening statement. You said, well, this doesn't look like there's a recession in 2024. I'm not so sure about that. We have not seen all the damage from what the Fed has done. And the Fed is not getting ready to cut rates. And we have one hell of a corporate debt rollover. It's 100% true. All these homeowners that locked in at those rate lows, they're good. They're good. They're prisoners in their home. They can't refinance, or else they're going to pay a 300 basis points extra. So they're prisoners. That's why there's no supply. That's why home prices are going up and screwing all the renters or kids living in their parents' basement. They can't afford to buy a home.
Right.
But the corporate sector, yeah, well, they're facing a $7 trillion debt refinancing at rates that will be on average 300 basis points above the origination between now and 2027.
All right. Let me just interject for 1 second here, because you're taking us exactly where I want to go. You are talking about something that I talk about an awful lot on this channel, which is the lag effect. That one can make the argument that for the extreme measures that the Fed has taken by hiking rates as high as they have, that we haven't seen the full expression of that yet, and it acts with a lag. It takes a while to get into the economy. It's been potentially pushed out, if you will, by a lot of the factors that you've already talked about here. So a big question I keep asking people, which I just would love for you to answer in your answer, is, has that lag effect been derailed or just deferred? It sounds to me like you're saying it's deferred, and you're going to start now talking about the corporate debt maturity wall, which I wanted to ask you about. And I've been hearing recently, there was a lot of sort of alarm bells being rung about it at the end of last year. Coming into this year, I don't hear them that much anymore. And I've even heard some people say, they've had some creative refinancing going on and it's not going to be that bad. Do you agree or disagree?
Well, we're talking about a $7 trillion debt rollover. So, I mean, I don't know. Or is everybody going to get a workout? All 7 trillion? Like, what percent are going to have creative financing? And we're including small businesses too, not just companies that have corporate debt, but all forms of loans. And the small business sector is paying an average interest rate right now of 9%.
Yeah. I mean, it's got to be more than double than what they were.
Yeah, well,
what they were paying before, right?
Well, once again, it's very interesting to me that we've had no growth in business capital spending over the past year. We had tremendous growth in industrial construction, but classic machinery and equipment spending is basically flat on a year-over-year basis. What is going on here? People have it in their mind that we have this great economy going on. It's been government, okay, and it's been the consumer that's been aided and abetted by the government and this drawdown in the savings rate. And of course, the consumer is 70% of GDP. But where's CapEx? And you look at the monthly numbers from the Commerce Department on core capital goods orders and shipments. There is nothing going on. There's nothing going on. And despite all this excitement over AI, well, AI is not the entire economy. There's no growth in capital spending. Why? Why? Well, what's happening is that the C-suite of corporate America, they're seeing the debt rollover calendar. They're seeing their incremental debt servicing costs that are going to cut into their earnings. That's why employment is slowing down, and we'll talk about why the numbers are actually worse than they appear at the headline level. But companies right now are being forced to retain their earnings to service their future debt servicing out of their cash flows. That money is not going to go into new hiring. That money is not going to be going into new CapEx. It's going to be going into debt service, and the corporate sector is preparing for it. And that comes out of GDP. And then there's all sorts of multiplier impacts and leakages from cutbacks at the corporate level, small business and large business, to the rest of the economy. So to say, well, no recession in 2023, therefore there's no recession in 2024 is like me saying back in December in Toronto, well, it didn't snow, so winter's been called off. And think about what a crazy comment that is. Look, people were saying the same thing back in 2000. Where's this recession? Where's this recession? Well, the lags kicked in, guess what? With perfect hindsight in March of 2001. All in 07, 2007, I'm at Mother Merrill. I was shunned. I was ignored and shunned, and it's as if I had leprosy. And the sales force stopped marketing me. It's a miracle that I got ranked an II that year. 07, I was just too bearish, and what do you know? Wrong on the recession call. And what happened in 08 was my calendar was jammed. I was working 24/7. And the clients were saying at the meetings I was at to the salespeople, how come you didn't take Rosie around to see me last year? Well, I'll tell you why. Because everybody believed, like you just said, Adam, I don't want to put you on the spot, but
No,
everybody
it's
said,
fine.
well, no recession in 07. Well, why would we expect one in 08? No recession in 2023. Why would we expect in 2024? So, yeah, I think that, the lags can be long when you get stuff jammed up along the way. In 07, there was still gargantuan housing related stimulus that kept the Energizer Bunny going right through the end of the year. But nobody at that point thought a recession was coming in 08. And so when did the Fed stop tightening? That cycle was in basically the summer of 06. And recession didn't start till the end of 07. So the Fed this time, the last rate hike was July of last year. And here we are in May, almost a year after. Yes, there are sometimes the lags are quick, sometimes the lags take longer. But for people to say to me that the US economy, a credit driven economy, is no longer interest sensitive and that the business cycle has somehow been repealed. What can I say? I stopped believing in fairy tales about 58 years ago. So forgive me.
All right. And it sounds like you're saying what you're seeing right now is really rhyming with the previous recessionary periods that you tracked in real time during those
Well,
eras.
every cycle is different. Every cycle has its peculiarities and its unique characteristics, and there's similarities, but they all end at the hands of the Fed, and only when the Fed tightens into an inverted yield curve. The only times in the past where we lucked into a perpetual soft landing, which was in the mid 1960s, the mid 80s, and the mid 90s, the Fed stopped. The Fed stopped before the yield curve inverted. But not this version of the Fed. And it's a different Fed, and they got burnt badly by transitory. They continue to feel as though their credibility is somehow and their integrity somehow is at stake. Nobody wants to be compared to Arthur Burns, that's for sure, especially a chairman heading into his last term. So they're deliberately hawkish. I guess we could argue that the last meeting, Powell wasn't that hawkish. I guess saying that we're not going to hike rates, I guess that classifies as being dovish these days.
Yeah, I mean, I was sort of like, I get he reduced QT, but this didn't seem as super dovish to me as a lot of the media has been making out.
Well, it's only again benchmarked against what was priced in. I knew. I was getting clients all the time asking me, "Will they hike rates? Will they hike rates?" I knew for a fact that he was going to be asked, and he was just asked repeatedly about whether they're going to hike rates. I mean, the
Right.
media in the room, they were like a dog with a bone.
Hmm.
They must have asked him 5 times. They hiking. Somebody says, "Was a rate hike on the table? Was it discussed?" Couldn't get. I mean, they're not. Look, they're not hiking rates. Question is when are they going to take out the restraint, which is what he said. And the reality is that he's not confident as to when they're going to do it. And I never seen a Federal Reserve so anally retentive on coincidental lagging indicators. I mean, he's telling us what they're looking at. They're looking at the unemployment rate. They're looking at job openings, relative to unemployment. They're looking at the inflation rate. Um, None of those are all lagging indicators. So they're like a central bank that focuses policy on lagging and contemporaneous coincident indicators is a central bank that's going to be destined to making a policy mistake.
Always going
Maybe
to be
what
behind the curve, right? Yeah.
they were behind the inflation curve, and now they're behind the growth curve. And they were behind the inflation curve, and then who knew the extent to which? And then next thing you know, we have an 18-month. Wasn't 18 quarters or 18 years. It wasn't the 1970s, but they got ahead of it. Uh, but they were slow, and now they're slow in the other direction. I mean, they are like a deer in the headlights. Uh, and so I think that the longer they keep rates at this level, and inflation is coming down, the trend is coming down. It means real rates are going up, and he's already said that the level of confidence they have to have after everything that's happened. And maybe what I have to do is put myself in their shoes. But after everything that happened, when they cut rates, they want to be as close to 100% sure that it's the right timing. Now, nothing's 100%, and the Fed they're like everybody else on this call. They're managing risk. But the risk now for the rest of us is that they're going to wait too long.
Mhm.
And it's not the first time. This is not monetary policy run by robots, not yet. And as brilliant as they are, they're prone to mistakes. And I think actually, if they had the choice between a recession and inflation, they choose the recession. And the one thing they're not going to tolerate is inflation. So they're going to cut rates. I think they're going to cut them hard. I thought at some point it would be a 2024 story, but they're telling us. And then the election will get in the way. I mean, Powell says we're not political, and they're not really political, but I think they'd rather stay silent, especially around this particular election. So probably more of a 2025 story where rates really come down and come down hard. Uh, but yeah, I think that there's serious risks. So he addressed them. He addressed the risks of waiting too long, but it's a risk, and they know all this stuff. It's a risk they're willing to take on.
Yeah, he said that in the past, where he said, essentially, if we're going to err, we're going to err on the side of tightening too much or for too long because we know how to fix that. We have the stimulus tools in place. It's harder to get inflation under control. Yeah,
Well,
and
yeah, fair enough.
sorry, and one other point too, just as I hear what you say is you're concerned that they're looking at coincidence and lagging data, right? So that's the proverbial driving by looking in the rearview mirror. Um, Not only do I think you think they're looking at data that is lagging, but I think you think they're looking at data that is lagging and flawed when it comes to the job market. True?
100%. And I mean, I was telling everybody who reading my daily, do not, or sure, I'll borrow the Joe Biden. Don't.
Don't.
Don't trade around non-farm payrolls. Of course, so what I wrote about was that we got something called the QCEW a few weeks ago. Acronym for what? quarterly census of employment and wages. It's everything. This is census data. And because it includes everything, including the kitchen sink, it's lagged. So it goes to the third quarter of last year. It includes 12 million entities. To repeat, it's the census, it's everything. Non-farm payrolls that the Fed bows to the holy grail of non-farm payrolls is 700,000 establishments. The QCW is 12 million. It's not a sample. It's not a sample, okay? Plus the response rate post-COVID in all these surveys, including non-farm, is down around 40%. It's rarely, if ever, been this low. So what the QCEW showed is that on a year-over-year basis, non-farm payrolls are being overstated by between 800,000 and 1 million.
Wow.
In other words, you got to shave the headline numbers by 70 to 80,000. And so why is that? Why is that? Because of the birth-death model. And I'm not talking about obstetricians here. I'm talking about that the BLS has a fudge factor called birth-death. It is a separate model that they've created, very sophisticated. And then they add on that number to the actual survey. Nobody talks about this. So they try and estimate through their birth-death model employment that they don't feel they're capturing by the existing non-farm survey by trying to estimate every month the net creation of business and what that's doing to employment. Now, I don't know what's going on at the BLS because I'm looking at the data. I have up-to-date data, and I could see that business insolvencies are up 35% over the past year. Now, I don't know. That sounds like a bit of a recessionary statistic, although it's not showing up in a lot of the other data, admittedly. It's not a consumer spending data, right? It has nothing to do with the savings rate. Corporate insolvencies up 35%, and the gross business formation is down 5% over the past year. And what do you know? What do you know? We get Friday's number, and as puny as the 175,000 number was, benchmarked against 240,000 consensus estimate, half of the growth in payrolls on Friday came from that birth-death model. Like basically you're talking more like 80 to 90,000 actually came from the survey. And so when you look at the data, you can see what's going on. They are massively inflated. And now we have the evidence from the QCEW. Not just that, but the QCEW also provides wage data. And between the wage data and the employment data in the census, this is not an estimate, that the current government data on income is overstating income by $650 billion. $650 billion of income overstatement, 800,000 to 1 million jobs. So look, I'm not a conspiracy theorist. I'm just talking about the fact that nobody is playing around with the numbers. It's just that these numbers, which were always flawed, they're based on surveys and they're based on sample sizes. What I'm saying is that the error term around all the data that people are trading around in their personal accounts, because who's not a day trader these days, and the data that the Fed is formulating policy decisions around have a much wider error term around them than they ever have in the past. That's where, once again, you get to a classic policy misstep, where this will basically be a major Homer Simpson dough. That's what it's going to be. So we actually have the bird in the hand. We know $650 billion. Dude, that's not chump change. That's 3% of income is being overstated. Do you know that if the QCW is right, and why wouldn't it be? It is the census data. It is the complete database. Do you know that the savings rate is not 3%. It's 1%. It's 1%. So to propel, like when we're looking at catalysts for what's going to drive the economy going forward, what's the bullish case that the savings rate is actually going to swing negative or going to
Hmm.
desave? So, but the major point is, and this is my big concern, is that the Fed is focused too much on data that has a very wide error term. And I think that, they were scrambling to raise rates. They'll be scrambling to cut rates. It'll be in a totally different market and macro circumstance than we have right now. But I am a little concerned that the Fed is focused so much. And I'll tell you, I didn't have this concern back in December, Adam, because in December, I felt liberated because Patrick Harker, who heads up the Philly Fed, gave a speech where he said that we are no longer going to be focused exclusively on the incoming government data. We are going to pay attention at least as much to survey data and to what our business contacts are telling us. And I said, well, that's exactly right. That's when the market started pricing in 6 rate cuts because they all knew what the vast majority, I guess they front run a lot of the retailers, including Starbucks, right? Like they sort of knew.
Yeah, that they were
So that's
struggling.
what Patrick Harker said that and then what do you know that in the December meeting, what does Powell talk about? The beige book, the venerable 53-year-old Fed beige book. I've never seen a Fed chairman spend as much time talking about the beige book as Powell did in December. So of course, the market front run the Fed will go from 3 cuts to 6. He's talking about the beige book. And of course, anybody who read the beige book in December was going, whoa, daddy, wow.
Hmm.
It was really weak. And the beige book is the richest piece of information, all anecdotal, but it's all what business contacts are telling the Fed. It goes back 53 years. To show you what a fun-loving guy I am, this is how I spend my time on the tarmac. I read beige books, but it is a wealth of information by region and by industry, right up to date on what's happening in the U.S. economy that is not in the data. So I'll just say that nobody talks about that anymore. Did Powell mention the beige book at the last meeting? No. Or the
No.
meeting before that? No. And they've all sounded very hawkish. Even Goolsbee, who was the last holdout on the Dover side, they're back to focus their data. See, data dependency at a time when the data have such a wide error term should be troubling for everybody. But the Fed told us in December we are going to listen to our business contacts. And the reason they said that is they said we should have listened to them before the inflation bulge because they warned us and it
Right.
wasn't in the data. So you read the last beige book that came out a few weeks ago. You can't read that beige book and come to the conclusion that this is a 3% growth economy. Not a snowball's chance in hell. Now, was it recessionary? No. But let's say that you read the beige book and it came right out with information right up to April. Pretty flat economy. Pretty flat. Pretty European like. Except Europe's coming at it from a situation where nobody expected anything but negative and flat is good. In the
Right.
US, it's like perpetual 3% growth, and the United States has miraculously uh, destroyed Mother Nature. There's no such thing as a recession anymore. But you read the beige book and flat, flat economy. Uh, and for all the anxiety and angst over inflation, you could not read the beige book and find any inflation. I know people like to talk about inflation because what they do is they conflate. They're talking on CNBC today about egg prices. Okay. Inflation is not prices, it's the change in prices. Paul Volcker, who is bigger than Paul Volcker, not just literally, but figuratively, the world's most acute inflation dragon slayer. But the price level under his 7-year tenure at the Fed went up 60%. Prices never went down. So people conflate prices and rate of change. And the beige book was replete with evidence from business contacts. They have no pricing power. They have no pricing power. Their pricing power that they had last year and 2 years ago has completely diminished. And all we have is a central bank that focuses on what? The CPI? The CPI? Really? The CPI, where 27% of the index is one question, owner's equivalent rent.
Right.
People know that 27% of the CPI that you trade around, I don't trade around these numbers. It's one question. It's not even, OER is not even a price anybody pays. 27% of the index, not gas, not food, not healthcare. It's OER. And it's one question to the sample of homeowners on the survey. What do you think you'd be able to rent your house out for in the coming year? That's what the Fed is basing its rates decisions on.
Right. Right. And that data changes with a long lag. It is a slow moving data point.
It's the only, if Alan Greenspan gave a contribution to society when he was Fed chairman, was back in 1996 in a heated debate with Janet Yellen. And of course, because in addition to the beige books, I read all the transcripts from the Fed. So to show you how I spend my spare time. And he said the CPI is a flawed statistic. The PC deflator, a little less flawed. But for example, everybody's talking about the inflation bump this year. Everybody's talking about the inflation bump. Sticky inflation. And I wonder, do people actually just talk, or do they actually do the research? That 100% of the deviation in the CPI from last year's disinflation trend. Now, I'm not going to say that we haven't had a hiccup. 100% of the hiccup, 100% of the deviation is from insurance.
Yeah.
Health insurance, auto insurance, property insurance. And those are things that are more of a tax increase. Those are not easy things to substitute away from. Of course, the biggest culprit is auto insurance, which is up 22%. And that's a lag response to the massive increase in claims. However, is that real inflation? It's more like a squeeze on disposable income. Insurance. The inflation has come from three sources. And in fact, when you look at US inflation and you apply it the same way they do in Europe, where, by the way, there's no owner's equivalent rent in Europe. So it's something called the HICP, and it puts countries' inflation rates on an apples to apples comparison. Now, Powell will never talk about this because he wants people to believe that we're higher for longer. So why would he ever? Why would he talk about this? He doesn't talk about it. But the U.S. inflation rate on a European basis is 2.4. Okay, you know where core is? You know where core inflation is when the U.S. core is put on the same basis as the European core. 1.9. 1.9. We're already below target. In fact, the 1.9 is lower than where it is in Europe. And the ECB is going to cut rates next month. And the Fed is basically just, fiddling his Rome burns, right? So
Right.
Very interesting dichotomy.
All right. Well, look, David, I want to, since we're getting near the hour, I want to make sure to get two more questions in for you if I can, or two more topics for us to talk about, one of which is just being your market outlook for the year, given all of this. Real quickly, though, I just want to pull up a chart, and you'll find it very familiar because it's one of yours. I pull this up from time to time. You mentioned that you think the Fed is, I'm trying to remember the exact terms you used, but you said it's going to be, right now it's really resisting changing rates, but I think you said they're going to start scrambling to cut at some point. And if that indeed happens, well, that would be very consistent with history, right? Every one of these times we raise rates, we hang out probably for too long at the plateau, and then the recession starts arriving and the Fed is just scrambling to cut rates as we go into that. So again, it looks like you're just thinking history is probably highly likely to repeat here.
Yeah, well, take a look at the data on the far left, starting in 85 into 86. Um, Volcker was still there, Volcker, and there was no recession, and they still cut rates 200 basis points. Now, the shaded regions are recession bands, and 100% of the time in the past, when the Fed has tightened and continued to tighten past the point of the yield curve inversion, which started in the summer of 2022, you've had a recession 100% of the time, but you never know. It's the NBER, not anybody else, is going to decide. It's the National Bureau of Economic Research that will decide when the recession begins. And with perfect hindsight, we can draw in recession bands. Now, take a look at the recession bands. They happen after the peak in the funds rate, not during, not before. So shame on all of us to have believed that the recession would have started last year way too early. Big mistake. However, to throw in the towel is also, you're going to double down on your mistake. A lot of people did that in '07, by the way. So that's 100%. That's a great chart because it shows that the shaded region happens after the peak, and the peak was last July. So I think the recession is still staring us in the face without trying to be cute enough to try and time it.
All right. Well, David, look, with that outlook, in terms of recession not derailed, just delayed, and maybe we're heading closer towards it as we get through 2024. What is your market outlook for the rest of this year? Looking through that lens, because if you're right and we start seeing increasing signs or precursors, at least, that we're headed more towards even slower growth and maybe even a recession, that's highly contrary to the current prevailing no landing narrative that still dominates the markets.
Well, in our monthly strategizer publication, we go through all the asset classes globally. Let's talk about the U.S. Our model for the U.S. is totally absorbed by the excessive valuations. So it's basically pointing to no return in the U.S. stock market in the next year. However, what's interesting is that the bond duration model has really improved a lot. So in our asset mix, we are continuously moving money out of U.S. stocks and into U.S. treasuries. And we actually think that the U.S. inflation is going to come down quite a bit. The Fed will be cutting rates. They're going to wait too long. But I think that we're going to have a yield curve in the next year that's going to be a lot lower and steeper. In other words, it'll revert to its more normal. 85% of the time in the past, the yield curve is positively sloped, just to show you how bizarre this has been in the past while. Only 15% of the time is it inverted, and we're living in that 15% of the time, but it's not normal. So the curve will invert, the curve will steepen, positive slope. The best returns will be at the long end of the curve. I think that you'll make 20% total return in the long end of the treasury curve, and I think you'll make zero. The reality is that with these valuations and with the equity risk premium actually almost close to zero, I don't see the arithmetic proposition for the stock market right now, but I expect that that'll happen in the next 12 to 18 months, and I'm going to be patient and I'm going to wait for it. But right now, what's not priced in sufficiently is the Fed cutting rates more aggressively than what's priced in. People have thrown in the towel on that view. And everybody's got a sticky inflation view, but I don't. I see that there's a lot of cyclical forces at play that's going to take inflation down quite a bit and surprise a whole lot of folks. So I think that bond yields will come down. You don't own treasuries for the yield. I get that all the time. Why would you buy a 10-year note at a 4% yield? Well, you're not buying it for the yield. You're buying it for the capital gain. Just people that ask me that don't understand convexity. So it's like an equity market person. Would anybody say buy the market for the dividend yield? Seriously? Buy the market for the 1.2% dividend yield? You don't buy it for the dividend yield. You're buying it for the capital appreciation. However, I would say within the S&P 500, where would you want to be? Well, there's places that you'd want to be. If the Fed cuts rates, like I say, it's going to have good news for bank funding costs. The yield curve will pivot. The banks, the big banks will be good places to be. Utilities, rate sensitive, telecom services, even select REITs. But I'd want to basically be in areas of the stock market that are correlated with lower interest rates. So whatever is a bond and drag in the stock market is where you want to have your concentration. Um, ordinarily lower rates would be good news for growth stocks. However, they're just too expensive for me right now. But at some point, their relative valuations will improve. They may be the first part of the market you want to get into as rates come down. The cyclicals I wouldn't touch because I cling to the recession view only because beyond being an economist, I'm also a historian. Um, I'd say that there's secular themes. Aerospace defense, for example, globally, defense spending has visibility. Uh, and there's areas of in the commodity markets that are not cyclical anymore. They are feeding into whether it's EV or the greening of the world or various infrastructure. You can take a look at the performance of copper in the past little while, telling you something about parts of commodities and critical minerals. Um, those are areas that I also like. Gold. Gold. Gold's in a bona fide bull market when it hits new highs in every currency terms. Gold is basically very good place to be when real interest rates come down, and they're coming down globally. So the gold bull market is intact, and it's going to drag silver and platinum and palladium along with it. I can't really comment on Bitcoin because it's just too volatile for me. I'd rather just own the gold. They probably have very similar principles, but Bitcoin is 4 times more volatile than gold is, and I don't want to have to, when people say to me, should I buy Bitcoin? I always tell them, well, make sure that you barbell your Bitcoin portfolio with a pacemaker. And, and as I said before, there's exciting themes around the world. I said before, our European models improved quite a bit, but I'm always a little skeptical about the European story, tell you the truth. Um, but emerging Asia is looking very good to us. Emerging Asia, Hong Kong is breaking out, but Japan is a buy and hold for us, and India remains the fastest growing economy. India, I will continue to say, India looks like China did 30 years ago, except they're a democracy and they speak good English. So that's something else that, again, you want to have a toehold in.
All right, fantastic. Thank you. That was wonderful. I really appreciate both the transparency, but the detail that you got into. It's a great list. All right. Well, look, in beginning to wrap up here, I have one last question that maybe we could devote an entire interview to. So it's unfair to me to ask you to just give your thoughts on it, within a minute or two. But I just wonder if there's any credence to this article that I've just seen making the rounds in the past 48 hours. And let me just read this to you. I think I took this from the Financial Times. What if I told you there could be an unprecedented stimulus injection into the US economy that will cost the government nothing and add not $1 to the national deficit? As early this summer, a proposed move could begin to unleash almost $1 trillion into consumers' wallets. By autumn, it could be on its way to $2 trillion. And this is all because last month, the government-sponsored mortgage finance agency Freddie Mac filed a proposal with its regulator, the Federal Housing Finance Agency, to enter into the secondary mortgage market, otherwise known as home equity loans. Is there any there with us? And if so, is this a good or colossally bad idea?
Well, it's just, again, an idea perpetrated by a a part of the economy that would benefit the most from it, the mortgage bankers. Yeah, so it's just it's like, for example, you coming to me and saying, I just read an article that the retail sector is pushing for an even further acceleration of buy now, pay later policies, which is just a credit card on steroids. So yeah, so it's not really anything more than incentivizing people to take on more leverage. That's what it is.
Yeah. But could that be
There's nothing free there. There's no free money there. It's just basically more leverage into the system to perpetuate the economy. Yeah, I guess if that happened, then you could continue to forestall the recession with more debt accumulation. That's all you're saying.
yeah, okay. So that is one of the big questions I had there was if this were to happen, could it defer the recession even
Oh yeah,
further?
well, that's the beautiful thing about leverage is that it can continue, right? It's just like Chuck Prince said, because that was leverage when he made that comment in in the summer of '07. Got to keep dancing until the liquidity's pulled away.
Mhm.
You got to dance. You got to dance to the music. So
Now I can't remember who said, the bigger the party, the worse the hangover, but would something like this make the
look,
inevitable down?
here's the problem with that is that it would frustrate the Fed's. The Fed is trying to ensure that supply and demand is in balance. So we're talking about a scheme that is going to fuel aggregate demand. What's the Fed's reaction function? You're not coming to me and saying, oh, here's the thing is that we have a new productivity. There's a new productivity thing that's going to cause an acceleration in the growth of supply. When people talk about the immigration boom, it has a supply impact and a demand impact. So the immigration boom is neither inflationary nor disinflationary. I actually thought that Jay Powell answered that question really well at the latest post-meeting press scrum. So we don't operate in a vacuum. So these people will come out and write this article in the FT, and there's a free lunch here of $1 trillion of stimulus. But if it's stimulus that adds to demand growth, the fallout will be that the Fed's next move will not be to cut rates, it'll be to raise rates. You might as well come to me and say, hey, the article said we're going to be getting, no matter what, massive fiscal stimulus next year. It's in the bag. You've heard it through Congress. And I'd say, okay, well, it's classic Newtonian physics. Every action has an equal and opposite reaction. And here's the problem. The Fed is not going to accommodate any more fiscal largesse. And I think that if we're talking about $1 trillion of cash flow to the household sector, and most likely all of that will get spent in the economy,
Mhm.
the Fed's going to raise rates. They're not cutting. So be careful what you wish for.
Okay. All right. Well, we'll track this thing, and I don't know what kind of chance it stands or whatnot, but it seems like it could be a pretty interesting curveball if it indeed got enacted. All right, David. Well, look, this has been, as always, just a wonderful discussion. For folks that have really enjoyed this and would like to follow you in your work, where should they go?
You just have to Google Rosenberg Research, click on, it'll take you right to the website. You can also go to information at rosenbergresearch.com, and you can also sign up for a free trial that way, or you can send in an email to us or call us, but that'll take you right to the website, and you can just tiptoe from there.
All right. Well, look, David, when I edit this, I will put up a link to Rosenberg Research prominently there on the screen so folks know where to go. I'll also put a link, folks, in the description below the video so you can get there with one click. Highly recommend that you go check out David's newsletter. And actually, very kindly, for those of you who are current Macro Pass recipients, if you're a premium subscriber to my Substack, I just talked to David before we turned the cameras on here, and he's interested in becoming a participating contributor there, and that would be fantastic. So stay tuned on that, folks. All right, wrapping up, David, I'm going to ask you one last question. I'm going to do just a little bit of housekeeping first, and that last question is going to be about a big lesson that you've learned. What's one big lesson you've learned across the arc of your career that you think is worthy of sharing with today's audience? Real quick, folks, while he's thinking of his answer to that, if you can let him know how much you appreciated him coming on for this interview and giving so much great information. To do that, just hit the like button and then click the red subscribe button below, as well as that little bell icon right next to it. And if you are looking to perhaps take action in your own portfolio with some of the insights that you learned here from David, unless you're a highly experienced do-it-yourselfer investor with a good track record of doing this on your own, highly recommend that most of the people watching this do that under the guidance of a good professional financial advisor. If you've got a good one who can handle that for you, great, work with them. But if not, if you'd like a second opinion from one who really takes into account all of the macro issues that we talk about on this channel, including the ones that I've talked with David about here, consider scheduling a free consultation with one of the financial advisors that Thoughtful Money endorses by going to thoughtfulmoney.com, filling out the quick short form there. All right, David, back to you here. Very highly successful man across the arc of your career. What's one big lesson you've learned along the way that you'd like to share with folks? Maybe it's something a valued mentor imparted to you. Maybe it's something that the school of hard knocks beat into you, but I'm curious to hear what that might be.
Well, there's, I mean, I've been doing this for 40 years, so there's a lot to choose from. Top of mind is Jack Rifkin. And I really advise anybody who's never heard of Jack Rifkin to Google him, Rivkin. He single-handedly took Lehman Brothers from the bottom to the top of research back in the 80s and 90s. And when I got to know him when I was at Merrill Lynch in New York, he was already the CIO of Neuberger Berman. They should actually erect a statue for him somewhere on Wall Street. He was legendary and forward-looking. So when I was in my last year at Merrill, I copied Bob Farrell and did my own rules to remember. Rosie's wasn't 10 rules to remember. It was Rosie's dozen rules to remember. Remember, Bob Farrell's a mentor of mine as well, and Bob Farrell's 10 market rules to remember. So it was a play off that, but it was about economic forecasting and tying in macro and markets. So one of my rules was to always seek out corroborating evidence to your view. The day I published it, Jack Rifkin calls me up and says, Dave, you have to call it back, change it immediately. Your rule number 5 or whatever it was. I said, why? He says, you should always seek out non-corroborating evidence to your view, not corroborating evidence, because then you're getting into your own level of groupthink.
You're an echo chamber, yeah.
And your echo chamber, and you are not checking your blind spots. So I quickly called the desktop publishers and compliance and my boss at research, and I said, we got to pull that back because we have to white out something, or not, not white out, but add in non-dash corroborating evidence. So that was actually a great lesson from a great mentor and a great friend.
All right. Well, thank you so much for sharing that. I echo something similar often, which is by definition, we are blind to our blind spots, right? So we always need to be looking out there through others' eyes to see what we can't see on our own. Hey, fantastic. And David, actually, when I send folks my notes from this interview, would it be all right? Do you still have those 12 rules? Would it be possible for me to share those 12 rules with folks?
I've got them. Yes, I got them somewhere. Absolutely.
All right. Well, if you can dig them up, send them to me, folks. And folks, just a quick reminder to anyone who subscribes to my Substack, free people, we send every one of these videos as it goes out. I will include in the free part of the video, if David's able to find them, his 12 rules so everybody can see them there. And then, of course, if you want to read my my actual summary of this key takeaways from this video, that'll be available in that same email to the premium subscribers to the Substack. So to get that, just go to thoughtfulmoney.com, click the little newsletter link at the top of the page. That's how you sign up. It takes you just a second. David, it's been fantastic. Thank you so much. Really look forward to having you back on the program again soon, especially especially if you're looking through your lens and see something that gives you great confirmation that the timing of your outlook is changing or accelerating or anything like that. If you have any audibles to call, we'd love for you to come call on this channel when you get a chance.
Done.
All right. Thanks so much, everybody else. Thanks so much for watching.